All right, I think we're good.
Okay. Good morning, and thank you for joining us on this Thursday. We know that your time is at a premium, so we're really glad that you could attend this webinar today. My name is Warren Yancey. I handle annuity product support and marketing here at the Milner Group, and today we have Bruce Beaty with us, who is the Vice President of Sales for the Legacy Marketing Group. And just for those of you that may be unfamiliar, Legacy is a company that works with carriers like Americo and F&G to design proprietary annuity products, and they've had a really long-standing relationship with us here. We wanted Bruce to talk to us today about really parsing through the complexities of annuities and revealing a little bit about how exactly they're priced. At the Milner Group, we really try to offer a wide array of annuity products and carriers, and we know that it can seem a little overwhelming with all the different moving parts and features available on them today. Of course, our annuity director, Julie Stewart, and I are always here to help you try to take advantage of these different options and really match your individual clients with the product that works best for their needs. But we hope that today this webinar can give you some insight as to why there are so many options and how exactly they can be customized. And the reason we wanted Bruce in particular is that we really think that Legacy's products offer not only really good caps and rates, but they also have several good index crediting options. And hopefully what you're going to find out today is that that can really be just as important, because you can have one product serve both clients that are bullish and bearish just based on the crediting methods that you choose. And with that, I'm going to go ahead and turn things over to Bruce and let him take things away.
Thanks, Warren, and thanks everybody for joining us on the call today. I appreciate the time out of your schedules. And my goal here today is to get you more informed about, first of all, the pricing of products, understanding the mechanisms and the dynamics of how these things work, so that when you're visiting with clients, you can have more effective conversations. You need to be able to address, really what the expected returns on the products are. And I think, based on where we're at in the industry, we used to sell upside potential 5, 6, even 7% that you can pretty much count on, with these products. And we've gravitated as an industry away from that because we're in a very low interest rate environment. So interest rates definitely have an impact on the products. So as an industry, we've shifted our sales focus to lifetime income riders. 80% of sales year to date almost have a lifetime income rider, which is fine. I mean, that's a great sale. That's definitely a strong need that clients have. But I'm still wanting to force the question here that I think we need to all address, is what happened to the accumulation opportunity? So I want to visit about that a little bit today. I want to give you some dynamics and some insight into, the engine that underlies this mechanism that we call a fixed index annuity, and really how these things work. So I'm going to do kind of a basic here of how annuities work in general. So first of all, when we sell our clients an annuity, they send in premium dollars. Those premium dollars go into an insurance company. You can't have an annuity without an insurance company. And insurance companies are, as we know, highly regulated entities. And part of that regulation affects what they invest in. So to keep it simple, pretty much they're buying bonds. Pretty much every insurance company is buying bonds. Now, there's some other stuff in there depending on the company. They may be able to mix some other things in their portfolio like real estate and, some various other things. But the majority of the money goes into highly rated bonds. So what happens when you buy a bond is, if I have a 10-year surrender charge annuity, I'm probably buying a 10-year bond or building a portfolio of 10-year bonds. So the duration of the bonds matches the duration of how long the client's money is basically going to be with us. So when that's done, the bonds generate interest. They generate yield. Okay. So out of that yield, I've got some choices as the insurance company. And keep in mind, we're in a pretty low interest rate environment. Basically, the overnight rate between banks is basically zero. Mortgages, as you probably see every time you log onto the internet, and mortgages can be had for 3% or 3.5% or something like that. So, interest rates are very, very low. So there's not a lot of bond yield. Even when you're buying corporate bonds, there's not a lot of yield to play with. So those yields can either generate interest that's credited to the client, or can be used to buy options. And options are how we create upside potential with an index annuity. An option allows us to profit when the stock market goes up, but if the stock market goes down, the option expires useless. And that's why we have a zero floor on the index annuity, because if the option expires useless, then really the only cost was the cost of the option that we purchased, but there's no loss to the client's principal. So that mechanism of purchasing options on the different market indices is how insurance companies are able to offer upside potential with no downside risk. So let's use an example so that we can all kind of understand this mechanism a little bit better. So I'm just going to, and this is not necessarily reflective of any particular corporate bond or anything like that, but let's just say in general that we're able to buy a portfolio of corporate bonds that average a 3% coupon. So if I've got a 10-year product, I'm buying a portfolio of 10-year bonds, and I know I'm going to make 3% yield, then basically over 10 years, that's a 30% return. Now, out of that, we have to pay for the manufacturing, the distribution, and the guarantees, and various other things. Let's say all those costs added up together take 10% of that total 30% return. So now that leaves us 2% per year to play with, basically. So we can either pass that through to the client and offer them a 2% interest rate, but 2% may not be all that appealing to the client. You know, you've got to look at it in comparison to other things. Now, CDs at the bank, it would take, about 10 years to make 2% in today's current interest rate environment. So it's certainly 2% is a lot more attractive than what the banks are paying. However, it's not going to keep up with inflation over time. It may not be that appealing. The client may just choose, if we offer them a 2% return, they may choose to just wait. So what can we do that's more attractive? Well, that's where we get into buying the options to create more upside potential. However, due to the low interest rate environment, there's not as much yield to play with, so it's hard to make that yield go very far as upside potential in general across the industry. So instead of crediting interest, the insurance company is buying these options, and the options provide the upside potential. Now, the option budget determines how much upside can be offered. The option budget's compressed in today's current environment compared to where we were 5 years ago, 7 years ago, 10 years ago, and so on. So we're not able to offer tremendous upside generally. However, there's a couple different factors that come into play. There's company differences. Some companies are better at buying options. They've got more experience or a different strategy that they use. Some folks are able to get economies of scale. Also, another factor that comes into play that's not immediately obvious is market volatility. The more volatile the marketplace becomes, the more expensive the options are, because the option seller, is going to make this transaction a little bit more expensive in a volatile market. So if you look at caps, caps across the industry have been challenged somewhat. So annual point-to-point caps on average, this information, by the way, comes from the company look2wink.com is their website. It's Cheryl Moore's company. They do tracking of industry statistics and so on. So Cheryl Moore tells us as of middle of last month, the industry average annual reset point-to-point, which is the most basic crediting methodology out there, is 3.22%. And that's on a product with a premium bonus, on products with premium bonuses. On products without a premium bonus, the upside potential is 4.18. So basically the proposition there is, and this is primarily based on the S&P 500, is if the S&P goes down, you don't lose anything. And if it goes up, you can make the first 3.2 or 4.8. Also, monthly cap is a very popular crediting strategy. The averages today are 1.46 on products with a premium bonus, 1.72 on products without a premium bonus. Monthly point-to-point or monthly cap calculates that gain on a monthly basis. So you would think you have a ton more upside potential, but based on the way the markets tend to move, Either way, you're looking at annual point-to-point or monthly cap at these caps and rates. You're probably looking at a 2 to 3% expected return over time. So that's a value proposition really of what the industry averages are today. So what we do at Legacy is we look at the industry and see where it's going. We look at what client needs are and what your feedback is, and we say, how can we create innovation? How can we bring something to the marketplace that's innovative, that solves a problem, that fills a niche out there? And that's where, over the last 2 years, we've really staked our claim and had tremendous success across the board, in particular in these last 2 years, due to one particular innovation. And I'm going to cover that innovation today and help you kind of cut through the hoopla. So chances are you probably get 4 or 5 phone calls a day from different organizations telling you about the latest, greatest, this, that, whatever. What I've noticed is the trend today is a lot of companies are looking at these challenges and saying, you know, how do we get people to get excited about products when we're looking at not a whole lot of return potential? So a lot of companies have come out with these hybrid indices. That's kind of the new latest, greatest trend, where they've got something with a brand name on it, you know, a money manager, if you will. That money manager is going to do a better job of creating options and so on and so forth. So, you know, that's the first trend that we're seeing. There are some challenges with that. I'm going to address that here in just a moment. But well, the first question we asked, and developing innovation for today's marketplace, is there any way to create leverage? Is there any way that we can create some realistic upside potential that our clients can have a better expected rate of return than 2 to 3%? You know, because that accumulation sale has not gone away. They're still looking for an opportunity to make some decent return on their money. And a lot of folks don't want the risk of being in the market. So there is some middle ground here. So the first question is, what if we could create leverage? Would that work? And the answer, by the way, is yes. That has worked very well. So with leverage, what we can do is create a larger options budget, which means we can purchase more upside potential. Now, what I mean by creating leverage is that we've introduced this innovation of a fee type of structure where the client's choosing to pay a fee to buy more upside potential. And we've done this on a couple different products with a couple different carriers, and it works very, very well. I'm going to show you here in a moment what we get. So if we were to rewind ourselves 10 years in the fixed index annuity marketplace, 10 years ago, 15 years ago, basically you put the money in, you have a strong minimum guarantee, you got upside potential, and that was all there was to the story. A few years down the road, the caps and rates got so compressed that everybody started selling income riders, which are available for a fee pretty much across the board. So the introduction of the fee has already been there, but what everybody was doing was buying longevity insurance. What we're doing is creating an opportunity for more upside potential with the fee. I'll show you how it works here. So the first product that we introduced with the fee, actually they kind of came about the same time, but the Liberty Mark and the Legend Mark, these two products, and I'm going to introduce those today as a solution here. Liberty Mark and Legend Mark both have fees. Now, Liberty Mark is a product level fee, and you'll see what you get with that. With Legend Mark, it's on a strategy level, so you can go either fee or no fee there. So these two products are our two newest product lines. They've done very, very well, and that fee is creating additional upside potential. There's a couple other products. We're not going to cover these two today, Spectrum Mark and Advanced Mark Ultra. They are very unique products and ones that I hope you'll study and take into consideration for your clients. Very, very compelling products and good sellers for us. But today we're going to focus on this innovation of Liberty Mark and Legend Mark and what we can do in today's interest rate environment to create more upside potential. All right, so with Liberty Mark, what you're going to see is an explanation that's pretty simple for your clients. In fact, the strength of this package of solutions is very hard-hitting for the clients that are looking for accumulation potential. Now, don't be confused. The 4 or 5 phone calls you get every day, primarily what most companies are pitching is this money manager in the background that's typically a Wall Street name, they've got a proprietary index with XYZ company, and they're going to try to enamor you with the hoopla, I call it, the fact that, this money manager, if they would have had this index, 20 years ago, these are the numbers, or 30 years ago, these are the numbers that, they would have produced based on their investment methodology. Well, quite frankly, anybody can look back 20 and 30 years and say, if I would have done this then, this is how things would have turned out. We can do that in our personal lives. If I would have known 30 years ago what Apple stock was going to do, I would have put all the money I could find in Apple stock, right? And I would look like a genius because I made a lot of money. I would have bought Facebook on the IPO, and so we can all look back into history, hindsight's 20/20, and say, if we would have done what our strategy is 20, 30 years ago, we would come out with this great number. Now, the other piece, and I want to challenge you on this, is if you are enamored with these, the hoopla of the money managers, I want you to really look at the mechanism, the product design. One of the things that's not immediately obvious with some of these is they use a volatility control. The volatility control, in some cases, is 8% or 5% or even as low as 4%. That means any time that things are going up, they're jumping into cash. Anytime things are going down within that indice, they're jumping into cash, which is a volatility control mechanism. But in some cases, with that volatility control being too low, it limits the upside potential. So if I had a volatility control of 4 on the upside, what would you expect? Your expected return could never be more than what? My way of thinking says probably not more than 4. So, there's some challenges there. So I want you to keep that in mind. And we also have a risk control. I'm going to be very fair on this. I'm going to show you a balanced conversation here on our risk control mechanism as well. But I want you to consider the shiny new object. It has a volatility control on it. It's not really able to generate that tremendous amount of upside potential you're looking for. So let's talk first about Liberty Mark. We designed this product to do a multitude of things, but the primary goal, the client objective this one satisfies, is one of accumulation. This product is not available with an income rider. It is designed to accumulate money. So we can go with either a 7 or a 10-year product. Some people like 7-year because it's not that long of a commitment. Some people like the 10-year because it's got a little bit higher caps and rates. Also, we give you the opportunity to give the client a premium bonus. So you can go either bonus or no bonus on each channel. So now I have a 7-year no bonus, a 7-year with a bonus, a 10-year no bonus, and a 10-year with a bonus. You can choose. Now, which one's better? Only time will tell. Caps and rates are higher on the no bonus products. They're a little bit lower with the bonus. So, the old analogy of a bird in the hand or 2 in the bush, that type of thing. So the bonus would be the bird in the hand. We know that we got that bonus locked up. Sometimes, clients have had a loss in their portfolio or something like that. We can help offset that loss to give them a bonus. The bonus on our 10-year product, there's actually 2 bonuses on the 10-year. There's one that's credited day one when the client buys it. It's a 5% bonus. The second bonus is credited at the end of 10 years. It's 10% on the full accumulation value. So my $100,000 goes to $200,000. The back end bonus is $20,000, and based on a $100,000 deposit, I got a $5,000 upfront bonus. So do the math on that. $5,000 plus $20,000 is $25,000. That's a very significant bonus on only a $100,000 deposit. In my analogy, I don't know what it's going to grow to, but I'm just using that assumption. And, that's at least double of the next biggest bonus out there. So, it's a tremendous opportunity. We built into this product 7 different crediting methods, 7 different strategies that you can move and parry with your clients. You can go to one set of strategies this year. You can reallocate to other strategies next year. The product also comes with a very strong minimum guarantee. Now, a fixed index annuity The worst case scenario over 12 months or 24 months or whatever the reset period is 0. But we're taking it one step further. The contractual minimum, and this varies by company, but our contractual minimum with Americo, that's the insurance company that we build this product with, is 1% on 100% of the client's premium. Now, if the client owns it for 1 year, had no growth, and was in the no bonus product, then the minimum guaranteed surrender value after 1 year would be $100,000 growing at 1% less the surrender charge. So you have to kind of outlive the surrender charge to have that minimum guarantee kick in for you. But that's either over 7 or 10 years. The strength of that is that we can quantify for our client a worst case scenario of a 10% increase over 10 years. So there's a 7 or a 10-year option. We also pay you full commission through age 80. That's significant because a lot of companies stop paying you full commission, somewhere in the 70s. So issue ages through age 80, full commission. We also have a big compensation opportunity for older clients. We pay up to 7% commission, 81 to 85. There's also no market value adjustment, which I'll explain towards the end of the segment. So what we did, the innovation here, is we added a product level fee. It's called the Liberty Optimizer fee, and that creates a tremendous growth opportunity for us. So it really enhances our options budget. We talked about the options budget earlier. It enhances our options budget, not just this year, but every single year on the product, and allows us to create much more upside potential than what you're used to seeing. Allow me to show you how that works. So this is our pricing on the Liberty Mark SE. You'll notice that there are 7 different strategies to choose from. Let me direct your attention to some of the most popular ones. So Liberty Mark SE 10, the most popular allocation here, this is the 10-year no bonus. The SE Plus is the bonus version. The SE 10 is the no bonus version. So on a non-bonus version, we have 66% participation rate in whatever the S&P has to offer over the next 24 months. So if the S&P goes up 10% 2 years in a row, that's 20% gain. Our clients would get 13.2%. Okay? So that's how that works. It's 66% of whatever the pure movement of the S&P is from today until 24 months from now. That's the most popular allocation because it backtests the best. That gives people a lot of confidence. I mentioned risk control earlier. We use the S&P 500 risk control. Now, if you studied risk control mechanisms, instead of using some brand name money manager from Wall Street, with a low volatility risk control, what we're using, and a low collar on that, what we're using the daily risk control 10%. So the client gets 105% of the daily risk control 10% indice on a 2-year reset basis. So this has very significant return potential compared to some of the others out there that I'm really with. I don't know if you are not, but here's another one, is the real estate strategy. This is based on the Dow Jones U.S. Real Estate Index. You get a credit 72% of whatever that index performs. So let me make this simple for you. This is a robust product. It's got a lot of different options in it. If my client is bullish, I'm going to put a third of the money in the risk control, a third of the money in the S&P 500 uncapped, and a third of the money in real estate. Why real estate? Well, it's diversified, so if they're wrong on the S&P, they still got a shot at making some money. It also resets annually. These 2 strategies are 2-year resets. I want to show my clients something on their statement every year. So I'm going to allocate amongst those 3. If they're more aggressive than that, I might also incorporate this 3-year blended monthly average participation rate. So it's 96% participation rate on the highest performer of the S&P 500, real estate, and gold. It's weighted 50, 30, 20 based on the performance. So 50% to the top performer, 30% to the number 2, 20% to the number 3. The client gets 96% of that. Let me keep it simple for you, though. This is debunking Hoopla here. We only use this for pretty aggressive clients because it is a 3-year reset. So I'm going to focus primarily on the S&P 500 for my bullish client, give them some diversification with the real estate strategy. If the client is not bullish, if they're a contrarian, if they're a bearish sentiment, I'm going to use gold because gold tends to go up if the economy's sour. So we get the first 7% that gold has to offer. The inversion strategy, which if the client believes the S&P is going to fall, will credit 8% on the downside of the S&P. So it's annual point-to-point on the negative movement of the S&P creates a positive return for the client. It's currently capped at 8%. If the S&P falls 10, your client gets credited 8. If it goes up, they get 0. If it goes down 5, they get 5. So they get 100% of the gain on the negative side of the S&P. It's a little bit different way of skinning that cat, but I think it's an interesting strategy. So I'm going to use those two, and I'm also going to incorporate real estate if the client's bearish, because real estate is not correlated to the market. It can continue to go up if the stock markets go down. So we use those three as a balance. Now, we can reconsider that next year. So if the client wants to go to those strategies now, they can do that, and then 12 months from now, once we reset, then we can reallocate to some other strategies. So you can move between all these different allocations. You're not stuck based on what you choose today. You've got the robust ability to reallocate and change with the changing times, and that's the power of this. It gives us a lot of control and flexibility. So that's the Liberty Mark 10 SE 10. We also have the SE 10 Plus. That's that bonus. Remember, it's 5% up front, and then whatever it grows to, we credit a 10% persistency bonus at the end of 10 years. Whatever the account value is drives another 10% gain. So I can use all these different strategies, and I can go bonus or no bonus. I can go 7-year with a bonus. The bonus on the 7 years, 5% persistency bonus at the end of 7 years. There's no upfront bonus. It's just paid at the end. And then the SE7 is a no bonus, but it's got very high caps and rates. So depending on what you're looking to do, what your client's objectives are, there's a lot of choice there. I will tell you, remember, this comes with an annual fee. So the Liberty Optimizer fee is an annual fee, and the SE version is 1.5% on the 7-year, 1.5% on either 7-year choice, or 1.75 on the SE10. So you've got a couple different options. You can go shorter surrender charge, a little bit lower fee, longer surrender charge, a little bit higher fee, maximum upside. The most popular choice is the Liberty Mark SE10. Now, its sister product is the Liberty Mark. Notice there's no SE. SE stands for Special Edition. This is the low fee version. So you're looking at a lower fee structure here on this particular solution. The caps and rates are a little bit lower here as well. So basically, what's the difference? Well, I like to use the analogy of the Camaro and the Corvette. The Camaro and the Corvette are both pretty cool cars, at least in my book. So what's the difference? Well, the Camaro doesn't cost as much as the Corvette. Also, it doesn't have quite as much horsepower. So, it's a pretty cool ride, but if you want the Corvette, you're going to pay a little bit more. You're going to get more horsepower. You probably get about 700 horsepower here. And I'm not sure what the Corvette's cranking or the Camaro's cranking out these days, but there's a sticker price difference and there's a horsepower difference. That's the analogy I like to use between the Liberty Mark and the Liberty Mark SE. The SE's got more horsepower. It's got a little bit bigger sticker price. The Liberty Mark has still tremendous horsepower, no doubt. Sticker price is a little bit less. So the annual fee for the 7-year is at 1%, and it's at 1.25% on the 10-year. However, the contractual minimum guarantee, which I mentioned up front, is 1 on 100. So we have a guaranteed increase of $10,000, worst case scenario, per 100,000 going in. So the fee cannot impact this. So that's the client's minimum guarantee. So those are the innovations. That's the type of things that we do here at Legacy. We say, how can we create upside potential? And the answer to that was having a product with a fee layer to it. But the cool thing is, this minimum guarantee basically says that if that strategy doesn't work out, you still make a 10% return over the next 10 years, which is about 5 times what the bank's going to pay you. So, as a worst case scenario, you do better than bank and you have tremendous earnings potential. I mentioned before that this product has no market value adjustment. I'd like to delve into that here in just a second, but one unique feature here, and I've seen this used in client presentations effectively, is that the product allows 5x5 annuitization, which means after 5 years, it can be converted to a stream of income of monthly payment for 60 months or 5 annual payments with the full accumulation value paid out over 5 years. That can be pretty awesome if you're working with clients in Social Security planning. And, there's some big changes in Social Security strategy planning, which is going to drive more and more people to want to wait to age 70 to claim their Social Security, but maybe they want to retire at age 65. So you can use a 5x5 strategy, accumulate from 60 to 65, distribute from 65 to 70 out of the annuity, creating the income you need to retire at 65, and then not hitting the Social Security benefit till you're age 70, where that's maximized. So I mentioned before this no market value adjustment concept. If you're not familiar with market value adjustments, most index annuities have an MVA or market value adjustment. So the way that works is if the client surrenders the contract early, let's say they bought a 16-year contract, for example. They're 4 years into it, their life changed substantially, they have to surrender it for whatever reason. So they get assessed a surrender charge based on the schedule, but then they also maybe assess a second penalty called a market value adjustment. Now, to be fair, market value adjustment can either be positive or negative. It depends on the change in interest rates between when the client bought the product and when they surrendered it. So here's my way of thinking about this. We're basically at the all-time low on interest rates. If interest rates go up, the value of bonds go down. In a rising interest rate environment, the face value of bonds that are purchased today, if interest rates are higher in the future, the bonds that we buy today are worth less. That means if the insurance company has to sell their 10-year bond 4 years from now, they're going to take a loss. Most insurance companies are going to share that loss with the client via negative MVA. Now, if you believe interest rates will go down from where they're at today, then you have a positive MVA. I don't see that happening personally. That's just my opinion. But the fact that we don't have a market value adjustment, I think is critical on this product because, if clients' needs change in the future, it's a very, very client-friendly product. So that's the first innovation. The accumulation opportunity is very significant. We have a calculator on each and every strategy that I mentioned that will show you contraction guarantee, the worst case scenario, the best case scenario in the last 10 years. So you can get a realistic expectation of what these things might do. And my challenge to you would be this. I think we've got the best upside story out there. The Liberty Mark is certainly an innovative product that can fit that accumulation space for your clients. So when you're doing profiles with your clients, working up objectives, not everybody wants lifetime income, and certainly not for all of their assets. So the opportunity is this. When they're looking for accumulation, consider the Liberty Mark. Now, the next product is the Legend Mark, and this will be the last product we talk about. But the Legend Mark uses a similar innovation, but this one meets two objectives, both accumulation and income potential. So it works like this. Caps and rates on this product, 3.1 monthly cap, 8% annual point-to-point. There's a third one called declared rate on gain. I won't go into that in great depths today, but if you were to consider, what was our industry average annual point-to-point when we started our conversation today? I believe the premium bonus versions of products across the industry were about 3.22% and a little bit over 4% on no bonus versions. This is a bonus product that offers the opportunity to get up to an 8% annual point-to-point, about double, well, actually a little bit more than double the industry average for bonus products. The monthly cap is 3.1. About double what the competition's sitting at today on an average basis. So if you like monthly cap, if you're familiar with that, if you like annual point-to-point, we've got the biggest caps and rates out there. Now, in fairness, this is for bullish clients because they're going to pay a 1% fee to buy these caps and rates. Here's the analogy I like to use. If you were to sit down with a mortgage banker today and take a mortgage out on your house, you can get a really low interest rate. But they're going to give you an option to buy down the rate. If you buy down the rate, you get an even lower rate. Well, that's kind of what this is on the other side. We're buying up the option. Now, on a no-fee basis, so within the same product, I can choose to either pay a fee or not pay a fee, and I can make this choice every year. I can mix and match, and I can reallocate. But our monthly cap here is at 2.1. Our annual point-to-point is at 4.75. Folks, that's stronger than where the industry's at, significantly stronger on a no-fee basis, and we give your client the option to pay a fee and buy it up even further. Now, this declared rate on gain, so we got strategies for bulls, strategies for pairs, and strategies for chickens. For chickens, I like the declared rate on gain because basically if the S&P goes up at all, it wouldn't have to go up, if it went up 1 point, we're going to pay this declared rate. So on the no-fee basis, that's 3.75. Folks, that is higher than the industry average annual point-to-point, and this one just says, all the S&P has to do is in the next 12 months is go up 1 point, and we're going to pay the client 3.75%. Or if they buy up the cap rate, it's at 6. And again, I can go half my money here, half here. I can go 10% to the bullish strategies, 90% to the bear strategy. I've got a lot of the income rider is very innovative. If you're selling income riders today, you know that roll-ups have been going down for the last couple of years. It's been a challenge to keep the competitive roll-up rates that we used to be able to sell. This product capitalizes on that. So the way that this rider works is, let's assume that it's based on growth, basically. So let's assume 100,000 grew to 200,000, and the client wants income beginning 10 years from now. So we take a multiplier, and we apply the multiplier to the account balance. The multiplier on this product, years 10 and beyond, is 150%. 200,000 now creates an income base of 300,000 with very competitive payout methods. So you've heard of the rule of 72, I'm sure. The rule of 72 says, what interest rate does it take from 100,000 to double over a given period of time? There's another mathematical rule called the rule of 115, and it asks what should take money to triple. Well, if we double at any point, year 10 and beyond, we're creating the tripling of the income base, and then also we have to know is what the payout factors are. The average roll-up in the industry is 6.1%. We beat that in the worst-case scenario we could find. We did almost 7% with this product. The last 10 years, 8.5%, and in the high market, almost 11%. So that's based on that 3.1 monthly cap with the multiplier. If I compare payouts, most companies, you put a client in at 65, you turn on income at 75, you're going to be between 10,000 and maybe 11.5 per year. We guarantee almost 10. There's a minimum guarantee built into it. But in the low market, we're pulling off higher payouts than the competition. Last 10 years, significantly higher payouts than the competition. And if everything goes perfectly right, we're blowing them completely out of the water on this because the payout per 100,000 deposited with this methodology was about $5,400 more per year, about $500 a month. So that's the legend mark. We pay upwards to 8.5% commission on the product. It comes with a bonus, depending on if you sell the 10-year, it's a 7% bonus. The 14 years, it's 8% bonus. This product gives higher caps. We can leverage higher caps. It also utilizes this performance multiplier to create significant payouts. I highly encourage you to study a illustration on this, compare it to whatever else you may have been selling before the call today, and I think you're going to be really impressed with what we can do for your clients as far as creating additional growth and income. And by the way, we're running this 50 basis point commission special right now, so that 8.5% is an increase. If you've been writing with us previously, you now have an opportunity to make even more money. On top of that, we have a litany of value adds, including marketing reimbursement program, the money for marketing. We also encourage you to use our application scrubbing and pre-suitability team in-house at Legacy. They'll run the suitability analysis before we send your application up to the carrier. We have an incentive trip, $2.8 million, gets you and your guest round-trip airfare to the Ritz-Carlton for 5 nights in Montreal, Canada next September. You got through June to qualify. If you're new to us, we're going to give you a $100 bonus on every app that you turn in for the first 90 days. And you have an opportunity to make excellent commissions with us. You're looking at leading commission opportunities in the industry where you're going to make 8, 8.5, even 9% commission, which is significantly higher than most companies. And the reason we can do all these things, when you look at this is a ton of stuff, paying out a lot, and great compensation and tremendous caption rates for your clients and bonuses, is that at Legacy, we're a very lean company. We don't have to pay for a building and 400 employees and so on and so forth like most insurance carriers do. We're very nimble, very lean and mean. Well, we're nice, but very lean as far as organizational structure. And we can create a tremendous amount of value. And we'd rather invest our dollars back into your business and creating marketing opportunities for you to meet more clients, than to buy a tremendous amount of infrastructure and overhead. So with that, I'm going to wrap up the call. I would like to direct you to our friends at the Milner Group. Warren kicked off the call today. You got to hear his voice. That's his direct line, 770-709-5470, or Julie Stewart, who's the Director of Annuity Operations there as well, 770-558-8904. We also have internally a sales team. The relationship managers on the sales team work in conjunction with your relationship managers at the Milner Group. So our sales team is there to answer your questions. One cool thing about it, think about it, is the Milner Group's located in Atlanta, and so they open at whatever time they open on the East Coast, which is really early here on the West Coast. It's 5 a.m. here. But we're here until 5 p.m. on Pacific time, which is 8 o'clock East Coast time. So you've got coverage. You've got people that are here to support you most of the waking hours of your day, regardless of where you live. So we all come together. We work together as a team to help support you in your efforts. So I want to thank you for attending our call. If anybody has any questions, you may type them in, and we'll be happy to address them. But other than that, I want to thank you for attending the call. We did record today's call, and we'll be sending that out to everybody. So thank you for your attendance, and any questions, please give us a shout. Thank you very much. Have a great day, everybody.